Looking at your tactical moves, Homin, you've got developed market equities downgraded to neutral. In the meantime, you like emerging market equities. I wonder if this suggests that you're seeing this long anticipated decoupling from the U.S. dollar regime and something of a continuing bull market for Asian equities. Walk us through your thinking here.
So first of all, the emerging markets, including those in Asia, are still cheaper than the developed market peers. Now, there's a reason why they're quite cheap. They have suffered quite a bit of relative macroeconomic performance issues in the past decade or so. But we suspect that that's beginning to stabilize a bit, particularly because the policy picture in the U.S. is beginning to deteriorate. We do have concerns about more politically driven decision-making at the Fed. So we'll have to see what kind of endgame emerges, between the White House and the Fed's current leadership regarding pressures to cut rates or maybe potential threat to change the leadership down the road. We'll have to see, but that's certainly medium-term a negative for the dollar. But when the dollar is either stable or actually facing a difficult prospect, that's not a bad situation to be for the emerging markets, right? That depend on the external funding to keep investing into capacities and achieve their catch-up growth. So overall, the stable medium-term dollar outlook is one of the reasons why we think on top of the cheap valuations, the setup is pretty interesting for emerging markets. And also another factor is the relatively stabilizing outlook for China. It is true that China will go through a deceleration the second half of the year, but at the same time, on the trade front, they do seem to have a genuine leverage in the form of rare earth supply control. And that actually gives us some hope that maybe past August 12th deadline for the U.S.-China dialogue, we might be able to simply keep the status quo. And we're seeing some encouraging signs from the U.S. in terms of export controls. So if that front stabilizes, with the possibility of maybe a targeted stimulus during the summer, the outlook for China, it becomes stable enough to support the other economies, especially in emerging markets. And that's another factor that we are considering.
Yeah. And with what you just said about the tariff negotiation outlook, do you think that would be the moment where investors decide, OK, I feel more comfortable deploying capital into China?
So we're neutral on Chinese markets still, even though we like some, TMT and consumer names listed in Hong Kong market. But if there is a genuine break in the outlook for the U.S. dollar, China will definitely emerge as a potential alternative. And now we're not there yet. China has a lot of issues. If you look at the June batch for macroeconomic data, it's clear that the imbalances have not been corrected and the domestic demand is actually beginning to slow down. So it's pretty important for Beijing to release additional targeted measures for the consumers to really stabilize growth outlook for the second half of the year so that maybe they get close to the annual growth target for this year and maybe keep the growth above 4% next year. So that still needs to be delivered. But if the outlook stabilizes, as we expect, and the picture begins to change for the U.S. in terms of fiscal discipline and monetary policy independence, then certainly the market will emerge as one of the more interesting places to consider for the investors. Not there yet, and that's the reason why we're still neutral. But that's still a possibility we need to think about as we head into 2026.